Can the SBI Life Smart Privilege Plus plan secure your future financially while enjoying the privilege of lifelong financial growth? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. So now before analyzing this policy, let us find out what is SBI Life Smart Privilege Plus plan is about. So this is an individual unit-linked non-participating life insurance savings product, and some of the key features of this policy are you enjoy life insurance coverage throughout the policy term, and you can pay your premiums throughout the policy term or for a limited period or even through a single payment which is at your convenience, and you can invest in a wide range of 12 funds in this policy, and there is no premium allocation charge starting from the 6th policy year, and loyalty additions are also start from the end of the 6th policy year for in-force policies, and you can manage your changing financial priorities with an unlimited free switching facility available under this policy. Now let us take a look at the benefits available under this policy. There are two benefits. First is the death benefit. So in the case of unfortunate death of the policyholder during the policy term, then the beneficiary will receive the highest of any of the following. You can see that's mentioned on the screen. So it can either the fund value as on date of intimation of the death claim to the company, or your sum assured, which will be less your applicable partial withdrawals, or 105% of the total premiums paid up to the date of death of the policyholder. Out of these three options, whichever is highest in value at the time of death, that will be given as a death benefit to the beneficiary. The maturity benefit will be the fund value as of date of maturity, which shall be paid in a lump sum once the policy matures to the policyholder. So as I have already mentioned, loyalty additions would be added to your existing fund value starting from the end of the 6th policy year on regular intervals. So now let's take a look at the fund options available under this policy, which are equity fund, top 300 fund, equity optimizer fund, growth fund, balance fund, bond fund, money market fund, bond optimizer fund, pure fund, mid cap fund, corporate bond fund, blue chip fund, discontinued policy fund. So all these funds are allocated based on the asset allocation they have, what kind of percentage of asset allocation they have to certain instruments. It could be equity and equity related instruments, debt instruments, money market instruments, and also according to the risk profile each fund has. It could range from low to high. So based on these factors, you can choose fund options which is suitable to you. Now let us take a look at the various charges we need to pay under the SBI Life Smart Privilege Plus plan. First is the premium allocation charge, which shall be deducted from your premium as they are paid before the allocation of unit each time a premium is received. So for single pay, it's 2%. For limited and regular pay for the first 5 years, it's 2.5% per annum. And from the 6th policy year onwards, there is no premium allocation charge charged. Next is the policy administration charge, which is a monthly 100 rupees charge for regular and limited pay and shall be deducted by cancelling your units. There is no policy administration charge for single pay policies. And there is also something called fund management charge, which they charge for managing your fund, and the charges differ according to the fund option you have chosen. So it can range from 0.25% to 1.35%. And there are also discontinuance charges, which is calculated as a percentage of your single premium or your fund value if you have chosen limited or regular pay policies, and it varies according to the year you choose to discontinue. And there is also partial withdrawal charge. So a charge of 100 rupees is applicable for every partial withdrawal in excess of 2 free partial withdrawal in the same policy year. And this policy does not charge you for switching or premium redirection, but it charges you for mortality, which is for providing you with life cover. So mortality charges are deducted each policy month from fund value by way of cancellation of units. This is charged based on your age and sum at risk. So your premium is not fully invested in your chosen fund immediately because of these charges. A portion is first used to cover various charges with only the remaining amount directed towards your investment. So unlike certain other market linked products, this plan imposes multiple charges that can gradually reduce your overall investment returns. Now let us take a look at the advantages and disadvantages of this policy. So let's start with the advantages. So the nominee here has the option to receive death benefit payments in installment during the settlement period and unlimited unlimited fund switches are allowed at no additional cost to the policyholder, and premium redirection is available starting from the first policy year in this policy, and partial withdrawals can be made from the sixth policy year or upon the policyholder reaching the age of 18, whichever occurs later. So guaranteed additions increase with the length of the policy term, providing higher additions for longer policy terms. So these are some of the advantages. Now the disadvantage would be there is a 5-year lock-in period in this policy. The loan facility is not available under this plan, and after applicable charges are deducted, only then your net premium is invested, which is a major potential drawback. And the minimum annual premium of 6 lakhs rupees makes this plan unaffordable for many individuals. So these are also some of the potential drawbacks under this policy which you need to carefully consider before choosing to invest in it. So now, as we have a basic understanding of this policy, let us now evaluate the projected returns, the potential returns from this policy by calculating the internal rate of return IRR to provide us with clear insights into whether investing in this policy will be suitable for us long term or not. So just for example purpose, let us consider that a 30-year-old male invests in this policy with a sum assured of 1.05 crores. The policy term and the premium payment term are both for 20 years with an annual premium of 15 lakh rupees. So at the end of the term, the accumulated fund value is payable to the policyholder as maturity benefit. So the policy brochure here projects fund value based on assumed investment rate of 4% and 8%. So these two assumed returns refers to the worst case and best case scenario respectively. But it's important to note these are not guaranteed returns. They only reflect a limited range of potential outcome. The actual maturity benefit of this policy will depend on the plan's performance over time. We are taking this assumed returns and calculating based on it just for example purpose. So at 4% return, the estimated fund value of this policy is 4.19 crores, which results in an IRR of 3.09% as per the SBI Life Smart Privilege Plus Plan maturity calculator. So at 8% return, which is the best case scenario, the estimated fund value is 6.56 crore, yielding an IRR of 6.99% as per the SBI Life Smart Privilege Plus Plan maturity calculator. But both the returns analysis here indicates that the SBI Life Smart Privilege Plus Plan may not justify the associated risk we take from this policy, because 3% is too low for the risk we are taking here and for the long-term time horizon we have invested in this policy. And 6.99% is similar to a debt instrument return. So as a long-term plan, its returns are suboptimal and may not help the investor accumulate the desired corpus. So choosing this plan could lead to a shortfall in meeting your financial goals. So considering the disproportionate risk and return present in the SBI Life Smart Privilege Plus plan, what we are going to do is we are going to conduct a comparative analysis where we are going to explore alternative investment strategies that offer us better risk adjusted returns. While ULIP does combine insurance and investment, we are going to separate these components to prove that it can be more beneficial to invest in insurance and investment separately. So for example purpose, we are using the same parameters from the previous example. So let's examine the two alternative scenarios. So in the comparative analysis for life coverage, a pure term life insurance policy with a sum assured of 1 crore costs 10,000 rupees annually for a 20-year policy term. So in comparison, the SBI Life Smart Privilege Plus plan premium was 15 lakhs. So by opting for a term insurance plan, the remaining 14.9 lakhs can be allocated to investments alone, which can be done based on your risk appetite. So if you are a conservative investor, you may prefer debt options like PPF, which is a public provident fund, government backed fund giving you guaranteed returns, and it also has tax benefits under section 80C. But if you are an aggressive investor willing to take a lot of risk, then you can explore equity focused investment like the ELSS mutual fund, which is also a tax saving mutual fund, and it has a good track record of giving average 12% and even outperforming in certain cases if you choose to invest in it consistently for more than 7 to 10 years. So what we are going to do is, in this example, we are going to consider two scenarios. One with a combination of term insurance plus PPF, another with a combination of term insurance plus ELSS investment. So in PPF investment, the annual PPF investment threshold is just 1.5 lakhs. But just for example purpose here, we assume the full balance is invested. So the estimated maturity value would be 6.61 crores, giving you an IRR of 7.04%. See, this is a debt instrument rate of return and a guaranteed return, and even then it surpasses the 8% best case return scenario of the SBI Life Smart Privilege Plus plan, despite being a low risk debt instrument. Another is the combination of ELSS investment with term insurance, where the estimated pre-tax maturity value would be 12.02 crores. The post-tax maturity value, if you after accounting for the capital gains tax, would be 10.89 crores, providing you with a post-tax IRR of 11.15%. So in both scenarios, you can see how separating insurance from your investment result in significantly higher returns compared to the SBI Life Smart's Privilege Plus plan. So this approach highlights the advantage of using a pure term insurance policy for life protection and investing the surplus in more efficient financial instrument to maximize your wealth accumulation potential. So now, what is the final verdict on the SBI Life Smart Privilege Plus plan? Is it worth investing or not? As you can see, this plan combines life insurance with market-linked investment. However, its long-term returns are moderate and fail to justify the associated cost. Various charges within the plan reduce the amount available for investment, which further impacts your returns in the long run. So a significant drawback of this plan is its high minimum annual premium of 6 lakh rupees. Additionally, as per the Finance Act of 2021, if the annual premium for any year exceeds 2.5 lakhs, the maturity proceeds, including your bonuses, become fully taxable. This rule significantly reduces the tax efficiency of the plan. So our analysis of the returns also reveals us that the plan's long-term performance is not only relatively low but also lacks tax advantage, and it also has a high agent commission. So what can you do instead? From a comparative analysis, we have understood that to effectively achieve your financial goals, you need to separate your insurance and investment. So for investment, building a diversified investment portfolio is a better strategy for accelerating your wealth accumulation process. And simultaneously, for life coverage, opting for a pure term life insurance policy provides you with superior financial protection for your family against uncertainties. So definitely you can opt for this kind of investment strategy where you combine term insurance and investment separately and combine it.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.